with Stratton Markets. Now, today's webinar is going to be based on a variety of different aspects with regards to trading. Now, a lot of people that I speak to, I tend to get the indication, the feeling that they're trying to become a millionaire overnight. So what I wanted to do is I wanted to create a webinar which in a sense can let everybody know exactly what trading is, what they can expect from trading, and what they should be trying to achieve from trading. Now, I recommend that everybody who is watching today's webinar have a pen and paper with them. If at any time you have any questions with regards to the webinar or something that I may be saying, please leave them to the end. At the end of the webinar, I'll leave a section where you can ask any questions, and I'll try to answer as many questions as possible. Also, I will put my email address at the end of the webinar, and you can email me at any time. Now, just to start off, I wanted to let everybody know a little bit about myself. I'm the market analyst here at Stratton Markets. I started off in the UK as a financial advisor several years ago. Since then, I've worked in different markets and economies around the world. I don't want to get too much into detail about myself. I want to go on to as quickly as possible Forex trading. The main thing that everyone should know is that I am a licensed financial advisor, even though I will not be giving any financial advice in today's webinar. Now, anybody which is new to Stratton Markets, maybe someone who has just opened an account very recently, they should be aware that Stratton Markets is a fully regulated financial brokerage. We are regulated by the European laws and the European regulator, which is CISEC. We have our own platform. It's an online platform, which means that you can trade anywhere where you have access to the internet. Now, I just want a quick message to everybody, especially people that are new to trading, something that they've never done before. Investing in the financial markets is an investment. Of course, as with all investments, it is carrying investment risk to the capital that you are investing. What I would recommend is everybody do their research with regards to the risk, make sure that it is something that they are comfortable with. Of course, we're going to go through this in a bit more detail in the webinar today. Now, today we're going to be talking about a few things. We're going to be looking at what to expect from Forex trading. We're going to be looking at some of the basics in Forex. We're also going to be looking at analysis, types of indicators that can help you in your day-to-day trading, what to expect from your investments. What I mean by that is where you should be setting your aims and objectives and making sure that they're realistic with relation to what it is that you're trying to do. We're also going to have a look at the week ahead with regards to the market as well, for anybody who it is currently trading. So let's start off with the basics, okay? I want everybody to be fully aware before they are actually trading and investing their capital in the markets, that they know what is Forex and what it involves. Now, Forex is a global market that allows you to invest in currencies, okay? When I say currencies, I'm referring to the British pound, the euro, the US dollar, etc. There's hundreds of currencies which individuals can invest in. Now, why would somebody be investing in a currency? Now, a currency has a value to it, Okay, the idea of investing and trading forex is that you're investing in a currency with the prediction that it is either going to increase or decrease in value. If your prediction is correct, you of course be in a profit. This is people's aim. This is what people are trying to do in the financial trading markets. Now, there's also other securities that people can be trading. There's also stocks. There's also commodities as well. When I say commodities, I'm referring to gold, silver, oil, gas, etc. So this is what Forex is. Now there's $7 trillion being traded on a daily basis in the financial exchange market. It is one of the most popular financial instruments. We're gonna also look at the different benefits and disadvantages that there may be involved in Forex trading as well. Now, when I say that you are investing in currencies, you're not actually buying the underlying currency. What I mean by that is if you are purchasing, let's say, $10,000, let's say you're investing $10,000 in the euro, you're not going to receive on your doorstep in a letter 10,000 euros, okay? If you are, let's say, investing in a stock, okay, you're not actually buying the stock itself. What you are investing in is something called a CFD. Now, this is something, there's lots of information on Google which you can find, but I'll also go through it as well here. Now, CFDs stand for contract for difference. CFD trading allows you to speculate on the rising and falling of fast-moving global markets such as Forex, shares, and commodities. With CFD trading, you are not buying the underlying asset, okay, but instead you are buying a contract which is mimicking the movement of the underlying asset. What that means in basic terms is you're not actually buying the stock or currency itself, you're buying another asset which price is the exact same. Okay, so let's say, for example, if the stock is $100, the CFD will be as well. If the stock goes up to $200, the CFD will be priced at the exact same. Now, why would someone invest in the CFD instead of buying the asset itself? There's different advantages and disadvantages to both investments. Some people may be looking to buy the actual assets themselves, but of course, there's very many people that aren't interested in buying the assets. They want to invest in the CFD. Now, the concept of buying and selling, you mustn't forget that you are trading, okay? It's the financial trading markets, okay? Now, one of the advantages of, instead of buying the asset itself, instead of doing that, to actually purchase a CFD in the asset, okay, is that you can make a profit and you can trade, okay, if the price of that asset is moving up or down, okay? Now, I'll explain that in a bit more detail. That doesn't mean whether it goes up or down, you're making money. If you are trading for a currency to go up, okay, and it does go up, you are making a profit. If you are trading for it to go down to lose value, then again, you are trading a profit. If you're not trading in the correct direction, you're going to be making a loss. However, if you're buying the actual underlying asset, there's only one way to make a profit, and that is if it's increasing in value. Whereas with CFDs, you can trade for an asset to be losing value. So let's say, for example, if there's a recession, okay, stocks are going to be losing value. If there's a crisis with regards to commodities, with regards to currencies, we've seen it with the pound very recently. The advantage of a CFDs is that you can trade for it to go down. If you are buying actual underlying assets, you are unable to do that. The only way you're going to be making money is if it is increasing in value, okay? So when I'm referring to buying or selling, you tend to see a buy and sell on the platform, whether it is our platform or a different platform. When you're buying, it means that you're trading for it to increase in value. You want the asset to increase in value. When you are selling, ladies and gentlemen, it means that you are looking and trading for the asset to be decreasing in value. Okay, so instead of it going from 100 to 110, for it to be going from 100 to $90, for example. Now, one of the advantages, what can be seen as an advantage, possibly also as a disadvantage, depending on people's views, is something called leverage. Now, leverage is when the broker is allowing you to, leverage is when the broker is allowing you to control more capital than your actual investment itself, okay? Now, for example, if you are investing $1,000 into your account and you have a leverage of 1 to 100, it means you have a buying power of $100,000. Now, that doesn't mean that you have $100,000 in your account. What that means is that you are able to be investing up to $100,000 in the market. You still have $1,000 in your account, but your buying power has increased to $100,000. So, for example, if let's say there is a security which is worth $100,000, you need $100,000 to buy it. Okay, if there's leverage of 1 to 100, you only need $1,000 to buy it. However, that doesn't mean you've got $100,000. Now, I say that there is advantages and disadvantages to leverage because it acts in a way as a double-edged sword. Now, with leverage, what it means is that it is increasing the market's movements, okay? If everything is being times by 100. Now, what that includes is your investment amount, the amount you are, the market is moving also. So if it is increasing value, okay, so your profit is being times by 100. If it is decreasing in value, and let's say you're making a loss, your loss is also being times by 100. So leverage can be seen as an advantage and as a disadvantage also. This is one of the reasons why a lot of investors are investing in CFDs though. Now, how the Forex is displayed, how the currency is displayed. Now, you will always see the security, the assets being shown as two currencies. You'll see a base currency, which is the first one, and a counter currency, which is the second currency. So it will always be shown as so. So Euro USD. If you come across an asset which you're not sure what the symbol stands for, because it will not say Euro United States dollar, it will show as EUR USD. If you just type it into Google, it will straight away come up with what the symbols stand for, okay? But you always see it as so. Now, the figure underneath will show you how much 1 euro will buy in US dollars. So 1 euro will buy you 1.1051 US dollars, okay? Which means the euro is worth more than the dollar at this present time. Now, if the figure here was a zero, okay, it means that the dollar will be worth more than the euro, okay? Do not forget that you can trade for both the euro to increase in value against the dollar or for the dollar to increase in value against the euro, okay? Which is one of the advantages, as we said, of CFDs. You can trade in both directions. The important thing is to be trading in the right direction, of course. You don't want to be trading for it to go up if it's going down. Now, what to expect from your investments? Now, of course, you need to massively look at how long you've been trading for, if you have ever traded at all also. If you've never traded at all, you should be expecting there to be in some way a training element, a learning curve with regards to your investment. So it's very important for everybody to be looking at how they're going to be investing, what they're going to be investing. Now, the good thing about here at Stratton Markets is that everybody is given an account manager. It's very good for you to be speaking to him. They're speaking to a lot of investors every day, and most likely, if you've never traded before, have a lot more experience than you. So in a way, they can give you some guidance with regards to how to use the platform, what is involved in the investment itself as well. Now, everyone should be aware that here at Stratton Markets, investing in CFDs, it is not an investment where you're placing the capital in, let's say, an account, and the capital is going to grow itself. The trading markets require your input. It is you personally that's going to be investing and trading. Okay? So everybody should be aware of that. Forex trading is most likely going to be short term. You're most likely not going to be making an investment into the market and keeping that investment open, for many, many months. Forex trading is classed as short-term investment. It's not so much long-term, such as real estate and bonds, for example. Now, placing your investment objectives. Now, as we said at the beginning of the webinar, that it is an investment and it does bear a risk. What I want to try and do in today's webinar is to make sure that everybody is trading sensibly, trading responsibly, and they know exactly what they are doing. Okay. Now, what we're going to be looking at next in this webinar is make sure that you have a trading plan and a risk management plan. Now, what most people, when they're coming into the industry, they hear about people becoming millionaires from trading the financial markets. Yes, there are these people in the markets. Nonetheless, these people definitely would have had training, they would have had a learning curve in a sense with regards to their investment. It's not something that's going to happen overnight. Now, what most people try to do on a monthly basis to try and earn 20%. Now, that can in some cases be quite high, especially if somebody's never traded before. Now, what I want to show everybody is that even if you're making a very small profit of 5% a month, that's still a 60% increase in your investment a year. Now, what most people are doing, especially in the UK, is they keep their capital in a savings account. In a savings account, you're looking at between a 1 to 2.5% interest per year. Now, even if you're earning 60%, that's if you are earning that, then you're looking at earning between 24 to 60 times more than you would in a savings account. Now, in my opinion, anybody who is making more than they would have been in a savings account can class themselves as a winner. But again, everybody's got different goals. They're trying to have, they've got different objectives. They're trying to do something different. But it's important that you're placing your objectives with regards to your investments at a sensible level. Do not forget, the more you're trying to make, more likely, the more strain you're going to be putting in yourself, and the higher the risk is likely to be. Set yourself a small target. This is what I did. Okay. Set yourself a small target, reach that target, reach it continuously, and then slowly increase it. Try and make 5% a month. If you're making 5% a month for 6 months straight, then increase that to 10% and so on and so forth. Again, I'm not advising anyone. This is what I did personally. Okay, it's important for everybody to be trading responsibly. Of course, it is down to you exactly how much you want to be looking to make on a regular basis. Now, a trading plan. It is massively important that everybody which is trading has two things. Number one, a trading plan, so they know exactly what they are doing on a daily basis, and a risk management plan. Now, most traders and investors that I speak to, which tend not to do very well in the market, normally try to trade the whole of the market. Now, there is hundreds of different assets in the world and on our platform also that you can be trading. It's impossible to keep up with all of them. So what a lot of people are doing, they're trying to trade the whole of the market. They might be looking at an asset they've never seen before. What you should be trying to do is pick between 5 to 7, okay, something manageable, 5 to 7 securities, and only be trading and analyzing those 5 to 7, okay, or even less, or maybe 8 or 9, nothing more. Now, when you are concentrating on a small part of the market, you're most likely going to be learning that asset and its movements and its news a lot more faster and to a much higher level. So ideally, it will be helping you to have a higher success rate. Okay, you should know exactly where you're going to be putting your stop loss and take profit. This should be part of your trading plan. Okay, and exactly the number of trades and the trade sizes you're going to be placing on a daily basis or on a weekly basis, however much you're going to be trading. Of course, somebody who is retired may be trading a lot more than someone who works a full-time job and also had little children at home. So, of course, depending on your personal lifestyle and as well as what you're trying to achieve, you need to design your trading plan with regards to that. Now, the next thing you need to be doing is a risk management plan. There needs to be some kind of risk management with regards to your trading. Okay. Now, what I want people to be concentrating on is mitigating your risk. Okay. What I don't want to see is people only trading one asset or one set of asset which is reliant on, let's say, one piece of news. So I don't want people to only be trading the US dollar, to only be trading Forex, okay? This is what a lot of people are doing. Now, I want people to be looking at the risk in the market. I want them to be mitigating the risk, to be spreading the risk as much as possible. So if you're trading, let's say, 9 securities, to be trading 3 Forex currencies, 3 commodities, and 3 stocks. Again, this is just an example. If you are trading, let's say, 6 currencies, to be trading 3 of those currencies in the US dollar and the other 3 not to be involving the US dollar, okay? To be spreading the risk, okay? You need to have a plan B in place. You need to also be looking at what is known as the safe havens in the markets also. So it's very important as traders that you are doing this. Now, sentimental analysis and in general sentiment and emotions in the financial markets can be an issue for traders. Now, it's very important to, feel good about your investment. You shouldn't be investing in something which, of course, your gut is telling you not to do. Yes, I completely agree with that, of course. However, I don't want people to be trading simply on emotions. I don't want it to become a little bit like betting. At the same time, everybody needs to be having patience when they are trading. Most traders which are not doing well in the trading markets tend not to be doing, tend to be trading without patience. So they're not waiting for the appropriate time to enter the market, or when they are entering the market, they're not allowing the investment enough time for it to be reaching their take profit or to be moving into a profit. Now, don't forget that 90% of trades are most likely going to be in a loss most of the time. The main and most important thing is that your trade eventually goes into a profit. For that to happen, though, you have to have the patience to sit back and wait. Of course, this patience is going to come with experience, no doubt. Now, what I want to illustrate to you is that there's indications and indicators, there's analysis which can help you with regards to trading. Now, on my screen, I have here the British pound against the Canadian dollar on a 15-minute chart. Okay, this indicator at the bottom of the screen here with the blue line is something called a relative strength index. Now, this is sometimes called in the market as an RSI. Okay, it's an indicator you can put on the online platform, or you can put it on the NT4 also. Okay, what it is doing is showing you at which point in the market is most likely to be oversold or undersold. What I mean by that is that it's either too high and likely to start coming down, or too low and likely to start going up. Okay, this could be because it's increased or decreased too fast. Now, you can see the indicator has a dotted line at the top, dotted line at the bottom. It is very simple. When it is at the top of the line, okay, it's likely going to come down. Now, it might be coming down massively, or it might be coming down very slightly. Either way, if you're trading for it to go down, in these three cases, you would have been making a profit at some point. At the same time, if the blue line is reaching the bottom, it is oversold. So that means that it is most likely going to increase in value. Okay. Now, there's different indicators like this that can help you. Another indicator is something called an MA, a moving average. A moving average on this chart is the yellow and red line here. Okay, what this is showing you is when a trend is forming. So you can see when the two lines cross over, like they do here, like they do here, like it does here, here as well, and here. It is indicating to you a new trend. So it crosses here upwards, and you can see it goes up. It crosses here downwards, you can see it goes down, crosses again, up, crosses again, down, crosses again, up. Okay, again, another great indicator that you can be using in your trading. Now, this is a very good indicator that I like to use. It is something called Ichimoku Cloud. Now, that might sound completely and utterly gibberish to you. Do not worry, it's a Japanese word. It is not that, in a sense, complicated. This is the indicator at the bottom. It's made up of two individual lines, and also this here, which is called a cloud. So you can see a negative cloud, a positive cloud, a negative, and a positive. So the red is negative, the yellow is positive. Okay. Now, I just wanted to show you different ways you can use this indicator. One, you can use the lines, which are a moving average. Just like the moving average, when they cross over, it indicates a direction in the market. Okay, so it crosses here, and the direction is correct. It crosses here, direction is correct. It crosses again, direction correct. Crosses again, direction correct. Alternatively, you can use the clouds. So when it crosses the cloud, like it does here, here it goes slightly up, not by much, but it does go up. Crosses again, it does go massively down. Crosses again, massively up. Crosses again, massively down. Okay, so there's different ways you can use this indicator. Now, this specific webinar is not for you to learn about these indicators, but I want to illustrate to you that there is different things that the account managers can show you, which you might possibly want to use in your trading. It might be something that can help you on your day-to-day trading. Now, I also want to show everybody what is going to be happening to the US dollar over the next week or so. Now, this week, we're going to have the Federal Reserve Chairman, Jerome Powell, speaking on Friday night. Of course, it's depending on which part of the world you're based in. Now, the Federal Reserve is the central bank in the United States, so it plays a massive part in the economy, in politics, and also in the currency. Now, of course, the Federal Reserve can have a massive effect on the currency. It can have an effect on commodities even, and stocks. Now, this Friday, what Jerome Powell, the chairman, is going to be speaking about is the United States monetary policy. Now, it is important that all traders will be paying attention to what he is saying, because he's most likely going to be giving an indication of how the future of the policy is going to, turn out. He's most likely going to be talking about interest rates. Is he likely going to be increasing or decreasing them with regards to inflation and economic performance? Now, of course, if he's saying anything positive, it will positively affect the currency. If he is quite negative over inflation and the economy and interest rates, then of course it is going to be affecting the currency negative. Okay. So everybody needs to know that there is most definitely a connection between inflation, interest rates, inflation, and also the value of the currencies. So everybody needs to know about that correlation and how it works. Now, investors will also be looking at the economical data based on macroeconomics being released next week. We've got the core good rates being released, and also the consumer confidence, the GDP, and some more information with regards to the economy. Now, it's good for you to have a financial economic Forex calendar. You'll be able to find these on there. Again, very similarly, if what is being released is positive, then it will be positive for the currency and for stocks and for commodities. If it is not, most likely, it's not going to have a good effect on it. Now, I want everybody to know that indicators and also economical data being released is never 100% accurate. So an indicator might be signaling a buy. It might not have that effect on the market. Don't forget that markets are priced to supply and demand. It might be indicating that there's going to be a higher demand for the currency, but if people aren't buying the currency, it's not going to go up. So again, it is just an indication. It is not the word of God. The same thing does apply to the fundamentals, to the economical data that I was just mentioning. So, for example, if the Federal Reserve says they're going to increase interest rates, which normally would make the currency increase in value, it might not on this occasion. Again, it depends on the supply and demand, especially the demand of investors. So this is why there needs to be a risk management plan, a trading plan. But everybody needs to know that there's not an indicator that is ever going to be 100%. Now that brings us to the end of today's webinar. I hope it was informative to anybody who was watching it. Now, I want everybody to be aware that this is my email here. If you have any questions or would like to speak to me with regards to something we mentioned with regards to the markets or in today's webinar, feel free to get in touch with me. If you do have any questions, feel free to ask. I hope that everybody has a great week of trading. Please trade responsibly. Please trade safe. Any questions, always ask us with regards to if it's your account manager or myself. And hopefully we will speak soon. Thank you.